Okay, so let's talk about staking on a big exchange like Binance. It can be a lot, right? You log in, you see all these high APYs, different lockup times, and coin prices that are all over the place. So how do you actually pick the right one? Well, in this explainer, we're going to build a super simple framework to help you cut through all that noise and make way smarter decisions with your crypto.
I mean, of course you do. Who doesn't? If you're holding crypto, you've probably asked yourself, can I make this stuff work for me instead of just sitting there? And staking? It's one of the most popular ways to do exactly that. So, before we dive into the how to pick a coin part, let's just make sure we're all on the same page with the what. We'll kick things off with a real quick primer on what staking actually is. Honestly, the easiest way to think about it is like a high-yield savings account, but for your crypto. By staking your coins, you're essentially helping to secure and validate all the transactions happening on that blockchain network. And for providing that service, the network rewards you, usually by giving you more of that same coin. It's a really fundamental part of how a lot of modern cryptocurrencies work.
All right, now for the main event. You get what staking is, but with dozens of options on Binance, how in the world do you choose which coin to stake? Let's build out that framework I mentioned.
And this is the million-dollar question, isn't it? It's not just about chasing the biggest, flashiest return. A great staking coin for you really depends on your own goals, how long you plan to be in it, and frankly, your personal tolerance for risk.
So we can break this whole decision down into 4 key questions. First, what's the APY? Your potential annual return. Second, what's the lockup period? How long do you actually have to commit your coins for? Third, how volatile is the coin itself? Is it going to swing wildly in price? And finally, what are the network's fundamentals? Is this a solid, legitimate project that's actually built for the long haul?
Okay, theory is great, but let's see how this whole framework actually works in the real world. We're going to apply it to 3 of the most popular staking coins you're definitely going to come across on Binance.
Let's start with the big one, the king of smart contracts, Ethereum. Staking ETH has become a massive part of its whole ecosystem, especially since it made that huge switch over to proof of stake.
With Ethereum, you can really see the trade-offs at play. Its fundamentals are incredibly strong. I mean, it's a market leader, but the APY is often a bit more moderate, and you might have to deal with some pretty long lockup periods. All of that makes it more of a conservative, long-term staking play for a lot of people.
Next up, let's look at one of its major competitors, a project known for its insane speed, Solana. How does this one stack up against our 4 criteria?
So with Solana, you're often looking at a higher APY and more flexible lockup options compared to Ethereum. The fundamentals are solid, with a laser focus on high performance and cheap fees. So what's the catch? Well, the volatility is very, very high. It's a newer, faster-moving project, which can mean bigger potential rewards, for sure, but also much bigger price swings.
And for our third example, let's check out Cardano, a project that's really well known for its super careful, research-driven approach to development.
Now, Cardano is pretty unique. It offers a stable and predictable APY, but its real claim to fame for stakers is this: there is no mandatory lockup period. You can delegate your ADA to a stake pool and then pull it out whenever you want. This gives you maximum flexibility, which you can imagine is a feature that a lot of stakers find incredibly valuable.
And this really brings us to the core trade-off you have to make in staking. Flexible staking, like with Cardano, gives you total freedom but usually a lower APY. Lock staking, like you see with Ethereum, offers a higher APY as a reward for that commitment. The right choice here? It depends completely on your personal strategy and what you're comfortable with.
Okay, so we've talked a lot about the rewards, but we absolutely cannot finish this without talking about the other side of the coin, the risks. And trust me, this is just as important as picking the right asset in the first place. And I really can't stress this enough. Earning rewards is fantastic, but you have to go into this with your eyes wide open to all the potential downsides. So it's crucial to get your head around these 4 big risks. Market volatility is number 1. A 5% APY doesn't mean much if the value of your coin drops by 50%. Then there's lockup risk, which means your funds are totally stuck, even if you desperately need to sell. There's also something called slashing, which is a network penalty where you can lose a chunk of your staked coins if the validator you chose misbehaves. And finally, remember, when you stake on an exchange, you're ultimately trusting that platform with your assets. And that really just sums it all up, doesn't it? Don't just blindly chase the highest percentage you see. Look at the project's fundamentals, understand the lockup period, and be really honest with yourself about how much volatility you can actually handle. The best strategy is always the one that lets you sleep at night.
So I'll leave you with this question. By thinking through these 4 things, APY, lockups, volatility, and fundamentals, you're not just guessing anymore. You're actually building a strategy. So, what's yours going to be?